Hi, I'm Jimmy. In this video, we're looking at Alphabet Incorporated, ticker symbol GOOG and GOOGL. Yes, they have two, but we'll come back to that in a minute. Okay, our goal with this video is to try to take a basic look at Alphabet's business and then try to see if we can determine the fair value of Google stock. Okay, now I'm sure we all know that Alphabet is Google, so from here on out, I'm just going to call it Google. Okay, so how about we start with the basics of Google's business? So Google breaks their business into two main segments. They have Google and then they have other bets. Now, I'm not sure why they do it this way because this is the way their chart ends up looking. So as we can see, using 2018 revenue, the Google segment represents 99.6% of all revenue. So Google classifies other bets as emerging businesses that are in various stages of development, and in theory, they're in large industries that have huge upside potential if they work out. But they're small right now, so they don't really affect what Google's doing all that much. Now, when we jump over to the Google segment, now here they do go one step further and break it into Google properties and Google Network member properties. So this does give us a bit more color, but not too much more. So in the Google properties, they have lines of business like Google.com or YouTube or Google Maps or the Google Play Store and things along those lines. The Google Network member properties, well, that's where revenue from external sites go, usually using platforms like AdMob or Google AdSense. And clearly, the Google Network member properties isn't as big as Google properties themselves, but they're still quite large. They generate just short of about $20 billion in revenue in 2018, while Google properties generated about $100 billion, just short of $100 billion last year. Okay, so before we try to come up with a fair value for Google stock, let's look at why they have two different stock tickers. So Google stock is actually broken into three different stock classes. They have Class A, Class B, and Class C. These are the number of shares that are available for each of those Google stock classes. I rounded them, but they're close. Now, we'll see in a second, it's not going to matter all that much anyways. So there used to be just two classes of Google stock. They had Class A and Class B. Then back in 2014, Google split Class A into two different groups, Class A and Class C. Class B shares are not publicly traded. They're the ones that are mostly owned by Larry Page and Sergey Brin, the founders of Google. Okay, simple enough. But here's where things get somewhat interesting. So as we know, when we buy shares of a public company, well, we become a part owner of that company. And one of the benefits of ownership is generally we get to vote at the annual shareholder meeting. We get to vote for things like who's on the board of directors and high-level items like that. Well, some companies, that doesn't exactly work out that way. Google's one of those examples of where it's a bit different here. So Class A shares, well, they get one vote for every share that they own. Simple enough. That's typically the way it works with most stocks. Okay, then Class B, well, they get 10 votes for every share that they own. So right away, we can see that the Class B shares get the majority of the votes. And we can't forget that Class B shares are not publicly traded. We can't get those shares. And then Class C, well, they don't get any vote at all. So Class A shares are represented by the ticker GOOGL. And Class C shares are represented by the ticker GOOG. And if we're curious, this is a chart of Google stocks of both shares, A and C, side by side. And as we can see, they look pretty much the same. They're very close to each other. As of last I saw, they were about $1 apart. So they're moving virtually side by side. Now we may ask, if Class A gets voting rights and Class C doesn't get voting rights, why isn't Class A more expensive? And the real answer to this is that it doesn't matter all that much anyways, because Class B ultimately controls the company. Page and Brin can't be outvoted, so what's the difference if we own Class A or Class C? Now, personally, I think that these two share classes are not equal. I prefer Class A shares over Class C, but here's why. So Google has a buyback program, and generally when they're doing their buybacks, they're buying back Class C shares. In fact, Google bought back about $22 billion worth of stock of Class C shares in the past 5 years. So we might say, okay, great. That sounds like a decent thing for Google stockholders, or at least Class C stockholders. Don't forget, GOOG is Class C. But when we look at the shares outstanding today versus the way they were in 2015 for the Class C shares, well, there are actually more shares now despite the fact that they've bought back $22 billion worth of stock. Why, you ask? Well, generally, employee stock options, and if Google were to make an acquisition, well, those are Class C shares that are getting issued. So essentially, all of the buybacks, all they're really doing is offsetting the Google stock options or the employee stock options and any acquisitions that the company is making. Now, I bring this out not because it's a huge deal, mostly because I want us to be aware that if they ever stop those buybacks, well, shares are likely to continue to be issued, and that could ultimately drive the price of the two stocks a bit further apart, where I think Class A shares will prove to be a bit better at that point. But that's just my opinion. Okay, so let's dive quickly into the financials, and then we'll try to come up with a fair value for Google stock. So this is Google's revenue, and as we can see, they've done a fantastic job of growing revenue. Over the past 5 years or so, they've had a compounded annual growth rate of about 20%. So it's been fantastic growth overall for Google stock. Now, when we jump over to profits, well, here we can see that Google's net income is once again quite good, except for the noticeable dip back in 2017. This dip was due to changes in the US tax law, and Google had to add on a tax bill of about $9.9 billion. That's why you see that dip in profit there. How about margins? Well, when we jump over to net income margins, we can see that after 2003 and 2004, net income margins have been fairly solid in the 20% plus area for a while. In fact, if we calculate the average over this time period, we can see the average annual net income comes in at slightly better than 21%. How about free cash flow? Once again, Google's done a pretty good job of maintaining solid free cash flow. And I know for anybody who's been in this channel before knows that I'm a big fan of using discounted cash flow to try to value a company's stock. So how about we try DCF for Google stock right now? So this is the results of the discounted free cash flow analysis that we've done for Google stock. Now, if you're wondering how to do this type of analysis, I actually have a full step-by-step guide as to exactly what you need to do to try to come up with this fair value. So if you're interested in trying to come up with this fair value on your own, well, I created an Excel template. It's free. There's a link in the description below to that website. Just throw in your email address and I'll send it over to you. Okay, so I'm going to run through these numbers real quick, and then I want to bring out something that tripped me up when I was first starting to research Google stock. Okay, so these are estimates, and I took these from analyst estimates that I could find. So for the required rate of return, I actually used 8%. Now, this is a bit lower than I typically like to use, but Google has a fairly strong balance sheet. And in theory, a stronger company would require a lower required rate of return. So for me, it made sense to use this for Google stock. I think 8% is a bit better than the 8.5% that I typically like to use. Usually I use 8.5 to 9%. 8% I think makes sense for me here. Now, one point regarding the strength of Google's balance sheet, for anybody who's been watching Google stock, well, we may have noticed that there was a big jump in their long-term debt. So this is a quarterly chart of long-term debt going back the past couple of years. And as you may notice, there's a huge jump in the first quarter of 2019. But when we dug a bit deeper, it turns out that this jump was actually from an accounting change that Google adopted in the beginning of 2019. With this accounting change, some leases are now accounted for as both an asset and a liability, hence the reason this liability shows a giant jump. Now, it's somewhat irrelevant because when we add cash and cash equivalents and short-term investments to this chart, we can see things have gotten significantly better. It's somewhat irrelevant whether they have 14 billion in debt or 4 billion in debt with the amount of cash that they're sitting on. Okay, jumping back to our DCF calculation. Next, we used a perpetual growth rate of about 2.5%. It's typically where I like to be, between 2 and 2.5%. Well, that gives us a fair value of the stock of about $14.54. That's, of course, assuming we believe the analyst projections and we agree with the discount rate and our perpetual growth rate. Now, when I first did this analysis, I actually got tripped up because of the shares outstanding. And when we go over to Yahoo Finance and we pull up their statistics page, well, this is what we're going to see. And I came across their shares outstanding, simple enough. And for some crazy reason, I simply copied the shares outstanding into our Excel template and got a fair value result of something like $3,300 per share. Now, yes, DCF valuation or any valuation for that point is just an estimate, but That would be way off considering where the current stock price is. So it turns out that the share class difference that we talked about before, well, that is playing a huge role in our valuation right now. See, this is GOOGL, and it has about 300 million shares outstanding. And then if we jump over to GOOG, there we can see that's an additional 340 million shares outstanding. Now, there are also Class B shares. Those should be included in this whole mix as well. So when I did the DCF valuation, I added all three together to come up with the proper number of shares outstanding. Now, if you're looking for the most accurate way to get these numbers instead of jumping from Yahoo Finance or whatever site we're using, the company's most recent 10K or 10Q, generally on the first or second page, will have the numbers listed as of the end of that quarter or annual number, whatever it is. Those are generally the most accurate numbers to use. Those are the numbers I used for our DCF valuation. Okay, so based on where Google's stock is currently trading and our calculation of discounted cash flow, Google's growth, they have solid net profit margins, they have a very strong balance sheet. I actually think that Google could make a good addition to a lot of value portfolios and maybe even a few growth portfolios. I think right now they seem fairly reasonably priced. Now their PE ratio is a little bit high, it's at about 24x versus the S&P, which is about 18x or 19x. So it's a little on the high end, but given its overall situation, given how strong the company is, I think it deserves to be up where it's at, possibly even higher. But what do you think? Do you agree that Google stock looks pretty good, pretty attractive at this price right now? Please let me know what you think in the comments below. If you haven't done so yet, hit the thumbs up. It really helps the videos. Also, hit the subscribe button so you can keep up with all the videos we're putting out. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.